Living off passive income is possible, but the version most people are chasing is quietly setting them up to fail. The internet sells this idea that once you hit a magic number, money just flows in forever. No work, no stress, no trade-offs. But the math behind that dream is fragile. One wrong assumption, one bad market sequence, or one underestimated expense, and the freedom you worked decades for can disappear fast. Here's the uncomfortable truth. Most people who do everything right don't fail because they didn't earn enough. They fail because they misunderstood how passive income actually works in the real world. And in the next few minutes, we're going to break down the exact math, risks, and psychological traps that decide whether passive income buys freedom or quietly takes it away. So before you plan your exit from work, you need to see this. Before we touch spreadsheets or rules of thumb, we need to clean up the definition. Because most arguments about passive income are built on a misunderstanding. In plain terms, living off passive income means your assets generate enough money to cover your living expenses without trading hours for dollars. No paycheck, no boss, no clocking in. But here's the part most people skip. For almost everyone who actually reaches financial independence, it's not a single, perfectly passive stream. Instead, it's usually a messy combination: investment withdrawals, semi-passive income, and a small amount of ongoing management. True, completely hands-off income exists, but it's slower to build, more expensive to buy, and far less glamorous than social media makes it look. That's why people who chase zero-work income often end up trapped. They underestimate the effort, overestimate the stability, and build a plan that only works in a perfect world. So instead of asking, how do I never work again, the smarter question is, how do I design income that keeps working when life doesn't go perfectly? Because that question leads us directly into the math that most people blindly follow and rarely understand. And it starts with a number you've almost definitely heard before.
If you spent more than a few minutes reading about financial independence, you've heard of the 4% rule. The idea sounds clean and reassuring. If you invest in a diversified portfolio of stocks and bonds, you can withdraw 4% of your portfolio in your first year. Adjust that amount for inflation every year after, and historically, you had a high probability of not running out of money for at least 30 years. Flip that number around, and you get the famous shortcut: 25 times your annual spending. Spend $40,000 a year? You need $1 million. Spend $80,000? You need $2 million. That simplicity is exactly why people fall in love with it. But here's the reality most summaries leave out. The 4% rule is not a promise. It's a probability based on historical U.S. market data. And history does not repeat itself neatly. More recent research has pointed out something uncomfortable. In environments with high stock valuations and low bond yields, a full 4% withdrawal may be aggressive. Some analyses suggest safer ranges closer to 3.3% to 3.7%. That sounds like a rounding error. It's not. At 3.5%, living on $40,000 a year doesn't require $1 million. It requires closer to $1.15 million. Same lifestyle, same spending, an extra $150,000 in capital. And there's another mental trap buried here. This isn't technically passive income in the classic sense. You're not living off interest alone. You're selling pieces of your portfolio and trusting that what remains grows faster than you spend. That works beautifully until inflation and market timing enter the picture. Because $40,000 today is not the same $40,000 20 years from now. Even modest inflation quietly raises the floor every single year. Fixed income that feels safe at the beginning can turn into a slow-motion pay cut, which brings us to the first hard rule of passive income math. If your income doesn't grow, your freedom shrinks. And that's why people who rely on safe income often feel secure at first, then confused when things start getting tight later. So the real lesson of the 4% rule isn't the percentage, it's flexibility. The people who survive long-term aren't the ones with the perfect number. They're the ones who can spend less in bad years and more in good ones without panicking. Because panic is where most plans break. And that leads us to the other side of passive income, the one that feels safer, more tangible, and more comforting, but hides its own expensive trap. When most people imagine passive income, this is what they picture: rent checks showing up every month, dividend payments hitting the account on autopilot, never touching the principal, just living off the cash. On the surface, this feels safer than selling investments. You still own the house, you still own the shares. Even if markets fall, the income feels tangible. And that sense of safety is exactly why so many people underestimate the cost. Here's the first mistake: confusing revenue with income. This shows up constantly in real estate. Someone buys a rental that brings in $2,000 a month and calls it $24,000 a year in passive income. But that number ignores reality. From that rent, you still have to subtract property taxes, insurance, repairs and maintenance, vacancies, management fees, and long-term capital expenses like replacing a roof. Once those are accounted for, that $2,000 a month can shrink dramatically, sometimes to a few $100s, sometimes less, and that's before taxes. To replace a $40,000 annual salary with net rental income, many people don't need 1 or 2 properties. They need 10 or more units, often owned outright. At that point, you're not passively collecting income. You're running a small business. The same logic applies to dividend-only strategies. High yields often come with hidden risks: slower growth, inflation pressure, or companies cutting payouts when conditions change. There's also a psychological blind spot here. We tend to undervalue our own time. If you're spending hours coordinating repairs, screening tenants, researching yield traps, or managing managers, that's work. It may be work you prefer, but it's still work. The IRS may label it passive. Your calendar usually disagrees. That doesn't mean cash flow is bad. It means pure cash flow is rarely passive unless you accept lower returns in exchange for professional management, which is why people who succeed long-term rarely rely on one model alone. Instead, they build something quieter, a hybrid system that reduces stress instead of chasing perfection, and that hybrid model shifts focus away from income entirely toward the variable that actually determines freedom faster than investment returns ever could. When you start seeing expenses this way, the math changes completely. Luxury isn't just about price, it's about time. Years of saving, years of work, years of delayed freedom. This is why cutting expenses often outperforms chasing higher returns. Most people obsess over returns. They spend years trying to squeeze an extra 1% out of their portfolio. Better stocks, better timing, better strategies. But there's a variable in this equation that's far more powerful and almost completely ignored. Financial independence math quietly treats every dollar you spend as permanent. Under the classic framework, each annual dollar of spending requires roughly $25 of invested capital to support it indefinitely. That means expenses don't just cost money, they cost freedom. That $15 monthly subscription isn't just $180 a year. It represents roughly $4,500 in capital you need to build and maintain forever. A $500 monthly car payment doesn't just hit your budget. It demands something closer to $150,000 in long-term investment support. Every dollar you don't spend does 2 things at once. It adds to your portfolio, and it lowers the amount your portfolio needs to generate later. That's a double win. One simple way to track this progress is what some planners call a passive income ratio. Passive income divided by expenses. If you spend $40,000 a year and generate $10,000 from dividends or side income, you're already 25% covered. And here's what people miss. Progress isn't linear. Covering your first 20 to 30% of expenses changes everything. Suddenly, survival pressure drops. Risk tolerance improves. You're no longer trapped in decisions you hate just to pay bills. At 50% coverage, work becomes optional instead of mandatory. You're not escaping life, you're choosing it. The real danger is the moving goalpost. People hit a number and immediately raise it. A bigger house, a nicer car, more upgrades. If spending rises with income, freedom never arrives. The treadmill just speeds up. The people who actually pull this off decide what enough looks like and defend it aggressively, against advertising, against peer pressure, against their own ego. Because the fastest path to passive income isn't earning more, it's needing less. And even if you get all of this right, the spending, the portfolio, the balance, there's still one risk that can destroy everything in the first few years if you ignore it. It's invisible, it's emotional, and it's responsible for more failed retirements than bad math ever was. There's one risk that can destroy a perfectly planned passive income strategy. Even if your math is solid, your savings are disciplined, and your assumptions are reasonable. It's called sequence of returns risk, and it has nothing to do with average returns. Sequence risk means the order of your investment returns matters just as much as the long-term average. Two people can earn the same average return over 30 years and end up with completely different outcomes, simply because one experienced bad markets early and the other didn't. Here's why this matters so much when you stop working. Imagine you retire with a $1 million portfolio. In the first year, the market drops 20%. Your portfolio falls to $800,000, but you still need to live, so you withdraw $40,000. Now, you're at $760,000. In year 2, the market drops again even modestly. You withdraw again. Suddenly, you've lost a massive portion of your capital before it ever had the chance to recover. Even if markets perform well later, you're compounding from a much smaller base. The damage is permanent. This is why average return calculators are misleading. They assume smooth growth. Real markets don't behave that way. They're volatile, emotional, and unpredictable, especially in the short term. The math is dangerous. The psychology is worse. Watching your life savings fall right after quitting your job triggers panic. And panic leads to the worst possible decision, selling at the bottom. Once losses are locked in, this is the part almost nobody talks about until they run straight into it. Many people reach financial independence expecting relief. No alarms, no deadlines, no pressure. And for a while, it feels incredible. Then, something unexpected happens. Anxiety shows up. Guilt around spending creeps in. Boredom starts to feel heavier than work ever did. This is why you'll hear stories of people with millions in the bank still stressing over a $5 coffee. Money solved the income problem, but not the identity problem. Work provides more than a paycheck. It gives structure, status, social connection, and a sense of progress. When that disappears overnight, the brain doesn't always react with peace. Often it reacts with confusion. There's a saying in the financial independence community: there's a big difference between retiring from something and retiring to something. If passive income is just an escape hatch from a job you hate, the relief is temporary. A vacation feels great. Permanent vacation often doesn't. Humans aren't built for endless leisure. We're built to solve problems. When problems disappear, we tend to invent new ones, obsessing over markets, micromanaging expenses, or arguing online just to feel engaged. That's why the most successful passive income earners don't stop working entirely. They stop doing work they hate. They shift to optional work, consulting on their terms, passion projects, part-time roles they actually enjoy, or creative work without income pressure. The goal of passive income isn't idleness, it's autonomy. This leads to an important distinction: lean financial independence versus fat financial independence. Lean independence covers survival. It works, but it's fragile. Fat independence covers luxury, but it takes much longer to reach. Many people land somewhere in the middle. Their passive income guarantees security, food, housing, healthcare, while optional work funds comfort and meaning. That balance removes fear from both sides. You don't need the job to survive, and you don't need the portfolio to provide purpose, which brings us to the final takeaway, the part that actually makes passive income. If there's one mistake that quietly destroys most passive income plans, it's this: people look for a single magic solution, one number, one asset, one stream that solves everything forever. That almost never works. The people who actually succeed don't build passive income as a finish line, they build it as an ecosystem. Here's what that usually looks like in practice. At the foundation, there's a core portfolio, low-cost, diversified investments designed to grow with the economy over time. This is what protects purchasing power against inflation and provides flexibility through withdrawals. On top of that, many people layer some cash flow, dividends, rental income, or other semi-passive sources. Not to cover everything, but to reduce pressure. Maybe it pays for groceries, utilities, or insurance. Just enough to lower stress when markets are volatile. They also keep a buffer, cash or short-term assets, so they're never forced to sell investments during bad years. And most importantly, they keep their skills and options alive. They don't treat work as a failure. They treat it as leverage. If income is optional, work becomes empowering instead of exhausting. This system works because it's flexible. If markets struggle, spending can adjust. If expenses rise, income can scale. If life changes, the plan adapts. The most secure people aren't the ones with the biggest portfolios. They're the ones who can move, financially and psychologically, when conditions change. So can you live off passive income? Yes, absolutely, but not by chasing perfection, not by eliminating work at all costs, and not by trusting a single rule or spreadsheet to carry you for 40 years. Real freedom comes from resilience. It comes from building income that survives bad markets, honest math, changing goals, and human emotions. Passive income isn't about doing nothing. It's about owning your time, protecting your downside, and designing a life you don't need to escape from. That's the real goal,